I'm joined by Sonders, the Chief Investment Strategist at Charles Schwab, and Kathy Jones, Chief Fixed Income Strategist, Schwab Center for Financial Research. It's great to see both of you. I want to start with you. You put out a report in mid-March about rising recession risk, but of course that was before we had that escalation in the trade war, although there's been some cooling in some of the rhetoric. How are you thinking about that risk factor now?
Well, Diane, shortly after the Liberation Day announcement, particularly in light of what we saw happen to the market in that very brutal 2-day period, just about anybody that publishes recession odds upped those odds. What's interesting is to the extent you can call what's happened in the last week or so a de-escalation, I think there's still a lot of uncertainty around that. I don't know that that eases recession odds all that much. It may mean that assuming we get a recession, that it's not as severe as it might have been if we had allowed that escalation to get even worse. So I think there's better than even odds of a recession in this environment. And I think maybe best case way to think about it at this point, even if there's further de-escalation, if you're a business and you've compressed your capital spending plans, your long-term investment plans, maybe it doesn't go further down from there, but it may end up looking like an L, if you can think of that visually. So I think we're not out of the woods yet in terms of the economy for sure.
It certainly seems that way, especially when you think about what we hear on some of the earnings calls recently with some companies just pulling guidance. So let me talk to you a little bit about, Liz, and I want to hear your thought about the link between the volatility that we've seen in the equity market and the economy. How would you frame that? Is there a direct link?
Well, I think one of the direct fundamental links between what goes on in the economy and the market is through the earnings channel. And maybe particularly important to talk about it in this environment, given that we're right in the teeth of earnings reporting season. Now, admittedly, the earnings being reported are for the first quarter. So that predated the serious escalation in the trade war via the Liberation Day announcements and what's happened since then. I think what's more interesting is what companies are saying about the future or what they're not saying about the future. So you've got a rising number of companies that are just withdrawing guidance altogether. And this is already a backdrop of 18 consecutive weeks now of downward revisions to 2025 S&P earnings. And I think when now analysts will be a little more left to their own devices in the absence of that precision around guidance, I think they are going to err on the side of bringing estimates down. So post-election, as we headed into the end of last year, estimates were for about 15% earnings growth for this year. That's now down to 8%, and I think the direction of travel is still lower from here. Then the other connection is that we have the largest share of household assets in equities ever in history. It's in the mid to high 40% range. It obviously fluctuates with market performance. So there are feeders in terms of the wealth effect from what happens in the equity market to the economy, more so than if you have a lower exposure by households to equities. So those are the two channels that I think are most relevant right now.
All right. Kathy, I want to get your thoughts on the Federal Reserve's path from here. There's been a lot of focus on Fed Chair Jerome Powell, especially given some comments from the president, and as it relates to the direction of interest rates. What are you expecting the Fed to do this year, especially given all the recent cross currents from trade policy?
Well, I think Powell in his most recent comments was pretty clear that they don't plan to do anything right now, that they are in timeout or on hold. And the reason is for the same reasons that Lizanne is citing about what businesses are doing or not doing. The Fed can't really assess where we are until they know about policy. A little bit more clarity on policy, I think, is the way that Powell said it. So we have the tariffs proposed, but they keep changing and pausing and on, off, et cetera. And what Powell said was that they had done a base case analysis at the Fed based on the previous set of tariffs in the previous Trump administration, but that these tariffs are much larger and much more broad-based than they had anticipated. So they're back to the drawing board on that analysis. And until they've done that analysis, they really don't feel comfortable making a move on monetary policy. So I think the idea is that Powell just wants to say, we're on hold, and we're waiting for more information, just like everybody else trying to function in the economy. And so our expectation is we're still penciling in like 2 rate cuts this year, but towards the end of the year.
Okay, so you think that will be towards the end of the year. And I know we continue to hear the messaging that this is a data dependent Fed. We've seen some pull forward of demand already in terms of some of the numbers. What are you expecting that could potentially spur the Fed to take action even sooner?
Oh, I think the primary driver would be a rise in the unemployment rate. You know, the Fed has a dual mandate for full employment and to keep inflation stable at low levels. If the unemployment rate were start to rise towards 5%, so if we start to see incremental increases over the next couple of months of, 2/10 or 0.3% from the low 4% region, I think that would get the Fed off out of pause and into action. It's an important metric for the Fed. Employment is actually a lagging indicator, so that would indicate already that the economy is very soft. The other thing would be, just much more softness in the economic data than we've seen. It's softening, but it hasn't signaled yet that we're tipping into recession. And then finally, if some sort of financial condition tightening occurred, then the Fed might move. But it's primarily going to be that unemployment move that would get the Fed to take action.
Lizanne, I want to hear your thoughts on the assessment of investor sentiment, especially because we've seen sentiment weaken, whether we're talking about the consumer or the C-suite. How would you characterize where investor sentiment is now?
It's kind of an interesting mixed bag with investor sentiment. I've tracked sentiment indicators for decades. And one way to think about measuring investor sentiment is the indicators, the indexes that are attitudinal in nature. So there's a lot of survey-based data on investor sentiment. You're asking their opinions. And then there's behavioral bucket of investor sentiment, what they're actually doing. And we're in a little bit of a mixed situation right now. In the last couple of weeks with this rampant volatility in the market, we've had these fits and starts where you see a big spike in bearishness, a big drop in bullishness. One of the most popular indexes that tracks that attitudinal sentiment is put out by AAII, so American Association of Individual Investors. They've been doing a weekly sentiment survey since the mid-1980s. And alongside this heightened bearishness and much lower bullishness, which all else equal can often serve as a contrarian indicator, you haven't really seen commensurate action in terms of what they're doing. Even AAII tracks the invested exposure of their members, and that's only a few percentage points off a high. You can also slice it, dice it. AAII tends to be older, more seasoned investors. If you look at professional investors, they're more cautious in this backdrop. But some of the newer retail traders are still in a buy the dip mentality. So a big divergence that's happened there in sentiment. I think we may need to get to a point where there's a little bit more of a washout. Still doesn't represent a perfect timing indicator, nothing is, but that tends to serve as a more definitive contrarian indicator when you have that washout both on the attitudinal side and the behavioral side.
Okay. Kathy, I want to get your thoughts on some of the patterns we've seen in the dollar recently. We've seen some weakness. We've seen some stabilization most recently, but it was concerning the momentum, the speed in which the dollar was weakening in particular, and then the volatility in the bond market had a lot of people concerned all the way, honestly, it seemed to be up to the White House. What do you make of it, and what does it suggest for markets going forward?
I think it's a reflection of the market reassessing the outlook for the U.S. economy in light of tariffs. And I think that you saw the drop in the dollar was probably exaggerated by, some leverage trading, et cetera. But it was the steepest 1 month decline we've seen in a long time, in a decade or more. So it was a very sharp sell-off. And I think that reflects this change in sentiment when we got those big tariffs, and combined with the criticism of the Federal Reserve and the talk about terminating Powell from the chair position, That really got people to reassess where the US is going in terms of economic performance and the underlying structure of our institutions. So we saw some of that selling. I think it's mostly foreign selling from what we can tell. We get the data with a lag, but it looks like from what we can see in the weekly data from Japan that Japanese investors sold US Treasuries for kind of about 6 consecutive weeks. Now they've come back into the market, but that's the largest holder of US Treasuries outside of the United States. So that's significant. It looks like it was households, not Bank of Japan, not the federal government agencies. And so I think this is a reassessment, and it's very unusual to see the dollar drop and bond prices drop or yields go up at the same time. That caught everybody's attention. And I think that that's just a reflection of the turmoil that we have off of various policies. Things seem like they're starting to stabilize now. I will say, if we pursue these aggressive trade positions and this policy going forward, the dollar is likely to continue to trend lower over the rest of the year. But that's very much policy dependent. But we don't also think that this is somehow a shift in the dollar's position as the world's reserve currency. I think this is not a reflection of the world moving away from US dollars permanently or for that reserve usage. It's more just a reaction to the shift in policy that we're seeing and the economic impact that it's likely to have.
I think that's a great response, especially because at this point, what else would replace it? Liz Ann, I want to get your thoughts on how investors should be thinking about navigating the uncertain equity market environment. Again, we've heard that term time and time again recently on earnings calls. So how should investors proceed?
Well, it is, needless to say, a very, very tough environment. And I would suggest trying to trade around these short-term gyrations. That's probably a pretty tough call. You'd have to maybe have an advanced Truth Social feed to get some of the incoming tariff-related announcements that as we've all learned, can cause really, really big swings, sometimes on an intraday basis. Taking the lens out a little bit further, the more defensive segments of the market have performed relatively better. You have factors like low volatility and stable dividend yield and stable profit margins from a factor perspective. Those have been some anchors to windward that at least helps cushion some of the downside. For the bulls out there, or those that want some sort of bullish sign, let me just throw something out that's a little bit breadth oriented. So there's a breadth indicator called the Zweig breadth thrust. Now I mention it, it's near and dear to my heart because the creator of it, Marty Zweig, the late great Marty Zweig, was my first boss in this business for 13 years, starting in the mid 1980s. And it looks at the number of advancing issues on the New York Stock Exchange relative to all advancing and declining issues. And lots of detail to the definition, but basically when you cycle very quickly from a really low level and you pop to a much higher level, that triggers the thrust. Based on history, other than the 1930s, and maybe that's an important reference point given we're talking about tariffs here, 6 months later, the market was up every time. But the exception was the 1930s. But I just wanted to maybe give something more optimistic for people to at least hang a short-term hat on.
Okay, well, I like the optimistic take. Also, I think it's an interesting take to say we could potentially see Truth Social being a leading indicator. Kathy, speaking of an optimistic take, you've said that volatility often creates opportunity. Where do you see opportunities in fixed income?
Well, we think that current yields where they are on higher credit quality bonds look pretty attractive. So you can get, if we take the aggregate bond index as an example of investment grade bonds, in a larger sense, the yields are above 4.5%. Some in the investment grade space are up to 5%. And the duration is around 6 years. So you don't have to go really super long term and commit and get that interest rate volatility. So that looks good to us for base. And then if you're in a higher tax bracket and a high tax state, which many of us are, municipal bonds, it's usually an individual investor driven market. So oftentimes it lags a little bit And that creates opportunity. And right now, the tax equivalent yields are really very attractive, 6%, 7%, in some cases even higher. So take a look. Tax day was just recently. Take a look, and if you're one of those folks in a higher tax bracket in a high tax state, take a look at the muni market, because it really hasn't caught up with where the treasury market is.
And one of those folks who owed, not a fun time. All right, we'll leave our conversation there. Opportunities to look for on both sides of the equation.